Well, Corey, maybe I'll just go ahead and welcome everybody. Thank you, growers, for getting on. I know there was a lot of questions around insurance options and with all the claims and stuff we had last year. So thank you, Corey, for agreeing to do this. And thank you, growers. And we also have a couple insurance agents that logged on. I think Angie Snyder and Emily Reisig. We're going to jump on the call. Anyway, with that, I'll let Corey take over. So.
Yeah, no, I really appreciate it. And yeah, thanks for taking the time, all you guys, to go through this. This is probably one of the relatively more complicated things to understand on insurance and one of the worst trained things on the agent side. Like, they don't really cover this at a lot of the agent training, so there's a lot of misinformation on it. And I just wanted to go through. I'm going to do a couple examples, one with you guys being in yield protection and contract pricing, and one in the malt endorsement with revenue protection, and kind of how that affects things, not just your claim on your individual side, but the county program payouts and stuff as well too. So is Mike, you're seeing my full screen, right, of my slides right now? Is that what you guys are? Okay.
Yes, I am.
All right. Sweet. So on quality issues, and this pertains to all the crops, if you're going to bin any production, it's always worth getting a state grain lab sample and having that sent in for insurance reasons, because we've caught so many things for that $30 sample that paid more on a claim just by getting that pulled and sampled in time. And the big thing with that is it has to be the state grain lab for that. So it can't be NQI. And it actually, for most of the quality issue side of things, we actually can't just take the samples like from Coors either. So we need to submit two samples here to make this program work correctly. And if any of you have questions, feel free to just chime in during any of this. But you have 60 days from harvest to get this done. So that's from the harvest would be when you finish harvesting that unit. So if you're an optional units, that'd be when the unit was finished for barley. If you're an enterprise units, that's when you finish harvesting barley. Where people get stuck on this oftentimes is maybe they went and they harvested their peas and finished those at the end of July, but then harvest stretched out till September. Well, the peas, the 60-day clock starts ticking on basically there. So um, always turn in a claim, even if you think there's a remote chance that you have a loss. I'm just going through some high level crop insurance stuff, but it's getting very hard to turn in late claims for us. So like if you get to November, December and think, oh shoot, now it looks like I might have a claim on this thing. It's going to be very difficult for us to continue turning those in. It's really easy to turn in a claim up front and sign off on it later. You don't have to go through all the hoops with the adjuster if you don't want to. So those would be some of the things that we see that get missed oftentimes here. I'm going to go through just really quickly. Peas and lentils are the only crop, one of the only crops that have a different way that they do the quality adjustment. So this one's really straightforward. If you have number two or less standard peas or lentils or chickpeas, what they're going to do is they're going to take, in this example, lentils that were supposed to be 25 cents at the elevator if they were number ones. They divide the number three price into it. So in this sense, we would have got 15 cents a pound for number three lentils. You harvested 10,000 bushels. And so how the crop insurance adjuster is going to handle this, if we went and got that bin sample submitted and those came back number threes, they're going to call around and see what you would get for number threes versus number ones. And they're just going to divide that 15 cents into the 25 cents you should have received if they were number ones, and they're only going to count 60% of your production. And the reason I'm going through this pea and lentil example is this is very similar to how your malt endorsement thing's going to work when we get farther down into that. And I figured a lot of you guys probably are growing pulse crops now too. So that's just one example of where taking those samples and the quality thing can pay a lot. So instead of counting 10,000 bushels against you for the claim, they're only going to use 6,000. So that's how we pay you more in the claim, right? The less we count of your production, the more we're going to pay you, or that might kick you into a claim. That must be done within 60 days of harvest. And then if you add that quality loss option, so we have till March 15th to add these options on these spring crops. If we put quality loss on these crops for you guys, and this would be the barley or these peas or anything that would get adjusted down for quality, that option allows you to use the 10,000 bushels on your APH or on your history instead of being stuck with the six. So I just wanted to kind of go over the options you could add now and then how the pea and lentil quality stuff works, because this has kicked some guys into some pretty large claims that didn't even realize they had subpar pulse crops just by pulling that $30 sample out of the bin. So on to what I'm kind of supposed to be talking about, and this is going to be more on the malt barley endorsement options, right? Or the malt options. And yeah, does anybody have any questions before I move on? Okay. And certainly I'll stop here after we get a ways into this malt thing too, because this is kind of complicated, but I hope I did this in a way that you can follow along with the differences in these two. So what's probably the most common thing done in the state is using yield protection with contract pricing. And I would assume a lot of you guys are set up that way. Um, One reason is it's cheaper. Another reason is it's not complicated, right? So when you finish harvest, they can come out and they can settle your claim in the bin. But when you do that, you're giving up two things. So you don't get to use the harvest price on the insurance anymore, and you don't get the malt quality adjustment stuff, which I'm going to go through two parallel examples of how this would affect your farm. So YP means yield protection. That means that you don't get to use a harvest price on the insurance. There's just one set price in the spring, and then they don't follow a futures market or anything for your harvest price. And I'm going to go through how that works just so we can review how revenue protection works again, too. So yield protection with contract pricing, if you do that, you can still use your malt contract to increase your price, which is good. You don't get to use the harvest price portion of this. You don't get a reduction in your production on the barley if it's rejected. So that's a big one, which I'll go through. And then it still qualifies for some quality reduction stuff on the feed side. So in my example, you're going to get a reduction even if you're in yield protection, if you have some high sprout barley, but it's going to be substantially less than had we switched directions and gone in revenue protection with the malt endorsement. So RP means revenue protection, just as a refresher for you guys, or if you're not familiar with insurance. These are elections that we would make here in March 15th. The malt barley price is used to increase your price on that, same thing. So you're going to start with the same base price. You get a reduction in production to count when your barley is rejected, which I'll go through how that works. And then there also will be a harvest price figured in there. That's all based off the wheat futures market. And I'm going to review this in detail here in a second. Then you can stack those feed barley quality factors and the malt reductions, and that really multiplies down the line, which I'll show you here too. So just real quick review on forms for you guys. Let me see if I can get a pointer up on here. If you look at this form that's on the screen, you can see it says barley, RP, and then here there's a whole bunch of crap, right? Like EU, MEYA. So what we're seeing here, this is an NAU form. All your forms will look similar that you probably just received from your agent, but the first thing you'd look at, am I in barley, am I in RP or YP? Because that's going to be a big decision, and this is when you can change that. The next thing shows what level you've elected, and then EU in this scenario means enterprise units. Some of you guys might say OU, that'd be optional units, or it might say EI, which would be enterprise units by irrigated practice. So for an irrigated guy with us, that would oftentimes be enterprise units by irrigated practice, and I'll kind of cover what the difference is in those as we go along here too. And then that ME, that's the malt endorsement. If this said YP, if it said yield protection here, that means you're in yield protection, and we'd have to put CP on here to use your contract, or that'd be contract pricing. So I'm just going to really quickly review how revenue protection works, because I find there's a surprising number of people that have never really gone through this on the insurance. So we're going to say in the spring here, you started with a $5 a bushel base price. This is on wheat, let's say. You have a 30 bushel guarantee on the insurance. So you have a $150 an acre guarantee. So whether you're in yield protection or revenue protection, you would start with this same guarantee. We're going to say here you only harvest 10 bushels an acre on your farm for that wheat. But then in August, when they do the average of that same futures market they use to establish this base price, in August, they're going to use the September futures, which is the nearby at that point, and it averaged $10 a bushel now. So for your insurance, if you're in revenue protection, they're gonna increase your guarantee, or the total amount we would pay you if you had 0 bushels, up to $300 now, right? So we got a $10 harvest price. That's going to increase your guarantee to $300 an acre. You go out and you sell the 10 bushels of production at whatever you want. The insurance does not care what you sell your production for in these revenue products. It's all based off the futures market. Your 10 bushels then is valued at $10 for your claim. So $100 of production is how this is going to work on your loss. But remember, we increased your guarantee to $300 an acre. You harvested $100 worth of crop, which hopefully you sold for $10, but you may have sold it forward at 5. It doesn't matter on the insurance eyes. So you have a $200 an acre loss now, even though your initial guarantee was only $150, and we cut 10 bushels. If you were in yield protection, we wouldn't have got this bump in the guarantee, and your loss would be substantially less here. So what happens when it goes down in harvest? And this is more of what's been happening recently, right? And so we're going to say you start at a base price of $10 a bushel. We have the 30 bushel guarantee still. That doesn't change. That's off of our average yield, right? So we're starting with a $300 an acre guarantee. You harvest 30 bushels an acre. So if you're in yield protection right now, you would not have a claim here, right? We're just basically, your claim is strictly based off of yield. So in revenue protection, though, we get to take the harvest price thing and figure it in there. So the price dropped to $5 a bushel in August on those futures. Your malt barley stuff's going to work the same way, even though you're contracted. It's going to track a price. You're on the revenue protection side. So now the 30 bushels we harvested is only worth $5 a bushel for the insurance. They never drop the guarantee below $300. So even though the price dropped, the guarantee will never drop. It can only go up. So your 30 bushels you harvested, even if you had sold it for $10 back here when the market was good, the insurance is going to value that at 5. You only have $150 an acre worth of crop that we harvested in this scenario. So because you're in revenue protection, you got $150 an acre loss payment. In yield protection, you would have received nothing. So does anybody have questions on that stuff? Okay, so that's the basic thing of every revenue protection product, and insurance works that way, basically. So on the malt side, if we have quality issues, like we said, always have bin samples taken on years, there's issues. Those are supposed to be taken by the adjusters. Oftentimes the adjusters don't have time to come out and either probe every bin or get your bucket samples. So sometimes they will allow you to pool your samples together into Ziplocs or whatever and get it to them. But technically a third party, a disinterested third party is supposed to do that sampling. You have 60 days from harvest to get this done. Technically, like on the malt endorsement side of this, Coors has 90 days to get the samples done, but I always tell people 60 days because that's your deadline for the feed barley side or the pulses or anything else. You need to have state grain lab samples for the feed side, which we'll get into. So you guys are facing a choice right now, right? You can either do the revenue protection with the malt endorsement part of this, and I would strongly suggest getting in the county programs, and I'll tell you why that is as we go forward. Or you can choose yield protection and contract pricing, and that would be one of the more common things we see with people that get rolled into our agency here for sure. So this is comparing your premium differences. So if you guys are in optional units, if you did revenue protection and optional units with the malt endorsement, it'd be $35 an acre. This is 100 and some bushel barley yield that I had done here, I think 105 or something. So that's $581 an acre of total guarantee when you stack revenue protection and optional units in the county programs all together. If you go to enterprise units, that goes from $35 all the way down to 19. So what a lot of our producers do is they take enterprise units with the malt endorsement, and then they'll use hail insurance to up their coverage so that on individual pivots they get covered if there's issues or something. So I wanted to show you the difference in the costs. If you were in yield protection and optional units with contract pricing, that'd be $27 versus the $35 for being in revenue protection with the malt endorsement. So a fair amount of difference, right? I mean, there's almost $9 a difference in premium, but the payout in the end can be so much bigger that I'm going to show you why, even if you wanted to stay in optional units, it's well worth being in this revenue protection side of this thing. Now, like I said, one of the complaints I hear from a lot of irrigated guys is, well, this never pays anyways. Two reasons for that is you're in yield protection. But then those same guys would also be in optional units and be paying this premium. Well, if this isn't paying you consistently, you might as well put it in enterprise units. And if the farm as a whole does well enough that you don't get a payment on the enterprise side, you're still probably going to be okay, right? So just quick for you guys that don't understand any of this insurance stuff, enterprise units means it's going to take all the barley in your farm and throw it together into one pot. If you pay more money for this optional unit option, it would pay down to the section level. So like every section could technically get paid separate on the crop insurance, where this is going to group all the barley in the farm together. If you switch that to enterprise units by irrigated practice, that would then split the dry land from the irrigated and still have the same discount as this would have for you guys. So that's the most common with mixed irrigated dry land guys that we would have. So there's two scenarios here, right? There's farmer A that selects yield protection with contract pricing at 75% and then gets in these county programs, which is the ECO, SCO. And that ECO and SCO, those are county-based disaster programs that are now subsidized at 80%. And so at the end of this presentation, I'm going to show you the returns on these, but it would be very, very beneficial to you guys to hop into those, I think, if you're not already. So farmer B selects revenue protection with the malt endorsement at the 75% level and in those county programs. We have 100 bushel an acre barley average yield, so we did an irrigated example here. $6 contract, which is reasonably close, I guess, to now. And then we had a $5 harvest price in this example. So the wheat market that we use to track your contract harvest price stuff dropped $1 when we got to harvest. So you have 95 bushel barley crop with 10% sprout. We're going to say it was 10.1 or something because that would push it to sample grade. So we had some quality issues. We had some sprout. Our rejected barley we sold for feed. And so the first thing I always get a question on is where do these prices come from? So if you guys don't have a malt contract to apply to this thing and you're in revenue protection or yield protection on barley, your base price, your prices are going to be based off the corn futures. So right now, through the whole month of February, they're averaging the Kansas or Chicago Board of Trade September corn future. And then they always have a factor that they're going to give barley for that. So for this year, you guys get 93% of what the corn price is. And that'd be for guys that don't have contracts to apply to the insurance, right? And that can all be found on the RMA site under price discovery if you care about that. But what if I have a contract to apply to this thing? So once we apply a contract to your insurance and you're in the malt endorsement, then it switches over to the soft red wheat futures, that Chicago Board of Trade future. And that is the same futures contract that you guys use for your Coors basis contracts. So we would then be using your malt contract to set your price on the insurance, but then we track what happens from February and then all the way to August with this Chicago Board of Trade futures price. And if that price drops, we're going to drop the price on your insurance to pay you more, even if you sell all your stuff at contracted price. So yeah, is there a question on that? Yeah. I know this is a lot. I'm just going to get you through kind of the intricacies of this, and then we'll get into the claims examples. So that price, if you guys ever want to track it, that's like right now it's averaging, and you have to go to the maltingbarleendorsement.com, and there's a private company that administers that. And you can track that price if you want. So your malt contract's used to establish the cover price. The other thing with the malt endorsement is if you're under contracted, so let's say you take your 100 bushel average yield and you did 1,000 acres, so you're supposed to have 100,000 bushels of contract. If you only have 50,000 bushels contracted, we're going to get to use your contract price for the 50,000 bushels or for half of your price in this average, and then we're going to use that feed barley price for the other half. So if you don't get enough contracts to cover your average yield times the acres you're seeding on the insurance, we're going to get a prorated price that's going to be mixed between your contract price and the feed price, basically. And then your rejected barley is either valued off what's called the posted county price at the FSA. If you were to feed that barley, that's where that would come from. Or oftentimes the adjuster will use whatever you sold your feed barley for what they're going to value your feed barley for the reduction here. So quick example, we have a farmer that signed up for yield protection and contract pricing. You have 100 bushel an acre barley average. You elect the 75% level on your insurance. So you have a 75 bushel guarantee starting out. Your 75 bushels is taken times that $6 price, which we established with our contract in this scenario, right? So you have a $450 an acre guarantee. You go out and you harvest 95 bushels of barley. So in this scenario right now, you'd be thinking, well, I don't have a claim, right? Because I have a 100 bushel average yield. My guarantee is only 75 and I cut 95 bushels. But we had 10% sprout on that barley. So the first thing that's going to happen on the feed barley side of this program, so this would be, there's two parts of it. If you take the malt endorsement, you basically have two policies running side by side there. So even though you're in yield protection, because we have poor quality barley, we get to go to what are called the charts on the crop insurance stuff. And your adjuster is going to say for 10% sprout, 10.1, I'm going to say in this scenario, but that's going to throw us into actually sample grade barley. So because our barley went sample grade, we would look at the discount factor on this chart, and you can see it says 0.263. That means they're going to take 26.3% of your production away for what they're going to count against you for this claim. Now, when we have kernel damage, which sprout is a big one on the malt side, once we get over 10%, we get to take additional factors and add it on top of that sample grade discount too. So we have 26% because it went sample grade, we don't have to count. And then another 4% because we were at 10% sprout. And I don't have this whole chart on here, but if we went down this chart, if we got to like 30% sprout, we might get rid of 60% of your production for this claim. Even though that doesn't affect what you get on the feed barley side, oftentimes for the price, that's just how this works on the insurance. It's all based off these charts on the feed barley side. So we're going to get a 30% reduction in our production, or a 70% of your production to count now, basically, for the claim. So we have 95 bushel barley that we harvested. We only have to count 70% of it for this claim, right? Because we had some quality issues. So they're only going to count 66.5 bushels against you for the claim. Remember, we had that $450 an acre guarantee. So our 66.5 bushels, they're going to take times the $6 price. Because in yield protection, we don't have another price. We just use the base price. So we're going to have a claim here. Even though we cut a pretty good crop, we had sprout, we were in yield protection, we weren't in the malt endorsement, but we only cut $399 worth of crop in the insurance eyes, even though we had cut 95 bushel barley. It got reduced because of the sprout, right? Had we not done those bin samples within the 60 days, we could not use this sprout stuff as part of the figuring, and you wouldn't have a claim here. So in this scenario, you have a $51 an acre loss. So that's great. We got a reduction somewhat because we had poor quality barley, but it didn't really reflect what we lost because we had to sell it for feed, right? So now we're going to go through the exact same example, except this is going to be a revenue protection malt endorsement farmer. So now you switch your stuff to revenue protection and you're in the malt endorsement. So we have the same yield. We still have the 100 bushel barley yield. 75% level, that's all the same. So we still have the 75 bushel guarantee and we start out with the same base price. So we're both starting at $450 an acre guarantee. But what happens now is some other things start factoring into this. So in this example, we're going to use that Chicago Board of Trade futures thing because we're now on the malt endorsement with revenue protection. We're going to say the wheat market dropped by $1. So in our claim example here, we're going to get to take $1 off of what they're valuing our barley at on the insurance claim, whether we have quality issues or not here. Okay, so once again, I really harp on that sampling stuff, but it's really important you get that part done. We're in revenue protection, so we get to use the harvest price. For this scenario, we're going to say the futures market dropped $1 a bushel when they did the harvest price calculation. So we're at $5 a bushel for our harvest price for the malt endorsement side. All the barley was sold and settled for feed, so all of this got rejected in this scenario. And this all has to happen before June 13th. So for you guys, like on the Coors, on the merchandiser side, it's really important to understand that part, because if we don't take delivery on barley by June 13th and have it sold and settled by that time, those guys have to then just consider all the barley that hasn't been sold and settled at that point as though it made malt. So what happened with Malt Euro a couple of years ago, a lot of the barley got stretched out for a year plus, and then the guys started delivering it, and Malt Euro told them they would take it way back before June 13th, but then they didn't take delivery on it till the next spring. Well, as guys started delivering it, they were rejecting these loads, and the insurance won't do anything about that. So that's why that June 13th date is a big trigger. The other thing that June 13th date does is it allows us to settle the barley in the bin. So like if you're going to keep some stuff for seed, which I know we're not supposed to do with Coors, but if if you're going to do that, that would allow you to keep some barley and then get your claim settled, and they would go back and look at all the stuff that was settled and give you the malt reduction on that. So in this example, we're going to say you sold your feed for $3 as well. So same example, right? We've got the 95 bushels of barley we cut at harvest. We have a $3, and this stuff all got rejected. We sold it for feed for $3. Our malt harvest price was $5 a bushel. Remember, our contract was $6, but now it dropped $1, so we're going to use $5 for this ratio. But then they're going to only take your production times the $5 in the end. So it all kind of averages out. But in this example, because we're in the malt endorsement, so this is something we didn't get to do on the yield protection side, we get to take the loss that we took for selling it for feed versus malt, and they're only going to count 60% of our production first off on the malt endorsement side. So right away, we're down to 57 bushels an acre. And then what happens is they're going to take that 57 bushels an acre and apply the feed side of the discounts to this as well. So we get the same discounts you got when you were in yield protection on the 57 bushels, not the 95. So same example, we have the 10% sprout. We're going to get a 30% reduction, right, in this production. But now we're reducing the 57 bushels instead of the 95. So our 57 bushels, we're only counting 70% for on the feed barley side of this insurance, basically. So we're only counting 39 bushels for our claim. We have a 39.9 bushel an acre average, or production for the claim to count. And remember, if you were in yield protection, we'd be counting 66 bushels against you for your claim here. And we only have to value this production at $5, where we had to value the 66.5 bushels at $6 because you're in yield protection. So two things that benefit you on a bigger claim payment here. And this is a very realistic scenario. Like this happens every year to someone and multiple people at our agency. So we have $450 an acre guarantee still because the price went down. That didn't go up. It would have gone up if the price would have gone up with the harvest price, but we subtract off the $199 that we're valued in now for being in revenue protection with the malt endorsement, and we have a $251 an acre loss versus 51 if we were in the feed barley or the yield protection with the contract pricing side. So there I'm going to stop for a sec because there's probably questions on this, but does anybody have questions? Is this about as clear as mud? Probably.
Yeah, I have a question.
Yeah, go ahead.
This is Shane Strecker. So if I understand you right, the harvest price is more of a factor with the endorsement than yield protection, correct?
Correct. There would be no harvest price at all in yield protection.
Correct. Okay.
Yeah. So, and that's a huge deal on those county programs because oftentimes it's the harvest price dropping that's triggering ECO and SCO because they're very shallow loss things. And so, yeah, as I go forward in this, I will, I did some quotes backwards or some data mining backwards to see how much of a difference it made being in yield protection versus revenue protection for those programs too. So yeah, you've got that. Yeah, go ahead.
So to make this fair, you're using $5 a bushel at harvest price. Shouldn't it be $6 to compare apples to apples?
That's so the lower price that we use for the claim, the lower the price we use on your claim side, which is what they're doing here, right? The more of a payment we'll make you. So we're going to value the crop at less. Your question probably more pertains to the slide before this, right? Where to make this fair on the malt endorsement side, why are we using $5 to figure out what you got versus $6 for the feed versus the malt, right? Is that what you're saying?
Yeah.
And I get that question a lot. And the reason is because you're getting the reduction at the end of the claim, we're valuing this at less at the very end. You're picking that up on that side of it because we're valuing the bushels that you cut at less. It basically comes out to the same place as if we took this and divided 3 into 6. Because at the very end, we're not using $6 for this last part, if that makes sense. If we use $6 here, then they should go back and use $6 on the reduction, but they work themselves out. I probably should have done that example slightly different so it made more sense, but you're basically picking up the ratio that you missed out on back there here. Anyways, with that.
Okay, thank you.
Yeah, you bet. I'm sorry, that's probably not a real good explanation, but it works itself out in the end. So So anybody else have questions on this part? And we can certainly go through more in the end if you want. So okay.
I have a question. This
Yeah,
is
go
Gina
ahead.
Aces. So if your claim is $251 on the revenue protection, do they take off then what you sell the barley for, the feed barley for, off that?
They don't. No, so that actually all was figured into this whole equation as we
Okay.
rolled along. And what's bad on the yield protection side is we don't get any consideration of that, right? They're just figuring you cut all these bushels of barley and you sold it for $6.
Okay.
Where on the malt endorsement, that's what that reduction is for. That was actually to reduce your production enough to pay you more because you lost money by selling it for feed. Where we don't get that with the yield protection and the contract pricing part of this. So
Okay.
yeah, really good questions. That'd be it. Okay, let me see why I can't use my clicker here. Just a second. Okay. Oh, here we go. And so the other thing this affects is these county programs. And like I said, the government just changed your subsidy on these from like they were subsidizing ECO and SEO at 65%. They upped it to 80%. So they effectively cut all your guys' premiums in half for this year for these programs. And a lot of comments I get from irrigated guys is, well, these programs never pay or they would never pay. Or well, I went back and I quoted them backwards and I did a comparison for you just to show how much they would have paid, how much your payments affected by being in yield protection versus being in revenue protection. And that's what this slide's going to show you. So I did kind of areas I thought maybe you guys would have a lot of customers in. So Teton County, Yellowstone, and Pend Oreille here. I do a lot with Toole County guys, but they've already been through our meeting, so I didn't throw that in here. But for you guys, like in Yellowstone County, since Mike kind of originated this meeting, if you were in yield protection with contract pricing and you had been in these county programs, and this is just the last 5 years, so from 2019 through 24, those county programs would have triggered for that 100 bushel barley yield at $327 an acre payable loss. And this is triggered on the county level, not on your individual farm level. So you all would have received these payments, whether you had losses on the farm or not. So this is ECO and SEO together. You would have got $327 if you were in yield protection, and you would have paid $33 in premium for that. If you were in revenue protection, over the last 5 years, you guys with 100 bushel barley average yield on your farm would have received $593 a payout on this program and only paid $70 in premium. So the premium is more when you're in revenue protection because the risk is higher, but it triggers so many more times because you can have the county cut an average yield for barley in this program, but the price drops 20%, and that'll kick you into payments. That makes sense. And I'm sorry, we probably don't have time to cover a whole lot of detail on these programs, but I wanted to show you that choice of being in yield protection versus revenue protection, and the choice of either being in these county programs or not can make huge differences in the end. So if none of you guys were in ECO and SEO during this period, even if you were in yield protection, a lot of you guys on average probably gave up $200 an acre. If you been in revenue protection, you may have netted $400 or $500 an acre. So there's some things that happen that yield protection affects not only on the malt endorsement side. It's nice to be in that side of it, but it also affects whether these county programs trigger or not too. So does anybody have questions on ECO and SEO or this particularly? I don't. Okay, not. We'll keep going. So the quirks of the malt endorsement. So there are some things that make this program a little bit frustrating, and the biggest thing is we must sell all the barley on hand before this claim can be paid out, or it has to. If that doesn't happen, we have to stretch it out all the way to June. So there's a wait period in here to get all the barley delivered. The reason for that is it might be that you have 10% barley or 10% sprout barley in a bin, but for some reason Malt Euro decides they're going to take that and try and use it for something on the malt end of things. They need to make sure all that barley is disposed of and before they'll pay this claim out. And that disposed of could be selling it, it could be milling it for feed, but it needs to be all either sold or used for feed before we can settle the claim out. And that's probably one of the biggest frustrations with this program. but you can see the claim difference can be huge, and it's probably worth waiting for your money. So must get state grain labs done to qualify for the later discounts. And so oftentimes Coors is awesome coming out pulling samples right with that probe thing. Take those samples that they leave in your bin door and give that to the adjuster and have him send those out to the state as well, because we can pick up extra discounts through the state grain lab stuff. And like I said, it has to be a FIGUS certified lab for the other side of that insurance, the extra discount. So that'd all have to be state grain lab stuff for that. There are frustrations with the state grain lab too. They've been super slow, but you can actually, if you want to, you can mail those to North Dakota or any other FIGUS certified lab. The adjuster could too. And our companies are getting better at knowing when the local place is getting overwhelmed and mailing those samples out of state. And actually, our own state grain lab started outsourcing some of the sampling too. So, the other thing is conditioning costs can be figured into your claim. So, especially on the irrigated size, I know you guys do a lot of sizing and stuff of barley sometimes. If you do that and it costs you, if somebody charged you 50 cents a bushel for sizing the barley, we can use that to reduce the price that they're counting against you on the insurance to get you paid back for the conditioning. It could either kick you into a claim or it might pay you more on the claim. If you're already in a claim, basically they'll pay your conditioning costs, oftentimes through the crop insurance if you're in the malt endorsement side, which that won't happen on the yield protection either. And then fed production must be milled or fed by June 13th. And so that's the end of what I'm going to cover on the malt endorsement stuff. And then I was just going to go through some highlight stuff on what changed in crop insurance. So this would be a really good time to kind of vet all the questions on the malt endorsement side if you guys want.
Corey, this is Mike. I have a quick
Yeah.
question. One of the things we saw this year, germination percentage is a big deal on factoring in on whether we accept or reject a bin.
Sure.
It seems like samples were getting sent to the FIGUS labs, and germination isn't a standard test for malt quality determination at the lab. So I was recommending guys request that. How does that factor into the claim? I guess is germination part of the claim?
That's a really good question. So that is germination is one thing that we can just use your guys' samples for if you want, because it doesn't affect the grading of the feed barley side of it necessarily.
Okay.
I mean, unless there's sprout that's causing some of the germ issues, right? Like maybe you had a bunch of sprout too in that. And that we would pick up on the feed side. But if the state grain lab doesn't test for germ, that doesn't really matter too much to us, because we'd still be able to use that low germ to show that it didn't make malt. And then we would need those two things. We'd need the test from you guys showing why you rejected it, which the germ in that example would be the thing. And then we'd need a letter of rejection from you that you send to the grower saying, I'm not going to take this barley. So that's one thing I forgot to mention in this presentation is on your guys' side, the grower is going to need, if it was germ specifically, because that's not a quality issue on the other side for us, then we just need the samples to prove that, hey, it was low germ and we're not going to take this barley because of that. And then we'd need a letter of rejection stating why you did it, basically. So yeah, good question. You can always ask for it on the state side too, but that would be one metric that we really wouldn't discount for on the other side of it. So we wouldn't necessarily have to have the germ through the state. But you were correct. They should send all this stuff to the state for all these other reasons, for sure. So
okay.
So yeah. Any other questions from you guys? Okay.
Are there any other quality parameters that they can use the contractor's results?
Yeah, so the only thing we're really using your guys as results for is to make sure that whatever you're using on your test is substandard below what your contract said you would use to accept it. So your testing, we're just using it to say, hey, should this barley be rejected or not, really? And then other than that, we will never use your results for the second step where we did the next reduction after it. So really, we can use your testing and we can use it to trigger the malt endorsement part, the first reduction, but we're never going to use your guys' samples for the next step in there, if that makes sense. So,
okay.
Why this is so confusing, I have no idea, but the government wrote it, right? So it is what it is. Yeah, anybody else? have questions? All right. Well, we can go through those at the end too if you want. These are things that change for the better for 2026. And maybe you guys know a lot of this stuff, but I thought I'd go through it just really quickly so you don't miss out on some of this. So like I said, your ECO and SCO subsidy changed from 65 to 80%. That made being in those programs kind of a no-brainer, which I'll go through at the end. If you do some new braking, if it's not native sod, especially, we don't have to do written agreements for that anymore, so that's automatically insurable. So if you have an old hay stand on dry land or something that's been in for 10 years, in the past we had a new braking agreements to get that insured. We don't have to do that anymore. If you guys take over any stuff coming out of a USDA program, whether it was in CRP or EQIP, you now have 3 years to seed that from when it comes out of the program instead of 2, and still get 100% of the county average. If you don't seed it within that time frame and harvest it, then you just get 85% of the county average for the first year. And then after that, it would roll into normal production. If you guys are canola growers, they finally added omega-3 canola as a type on the canola, and we can use your contracts to increase the price. Unfortunately, that timing when they released this happened to coincide with them not contracting for this year for that anymore. But in the future, if that happens, we'll be able to do it. And then if any of you guys grow pulses for seed for someone, it has to be under a seed contract, but we can use that contract now to increase your price on the insurance side. So that's a pretty big deal, because we're looking for something that would cash flow this year. And so if any of you're doing that, or if you can get a contract to grow seed for someone, that's one way we can increase your crop insurance guarantee on the back end here. A few more just quick things in that big, beautiful bill. The beginning farmer rancher discount increased from 5 years to 10. So if you have somebody new coming back to the farm and they start their own entity, so they're not involved in your operation, they get 10 years of highly discounted premiums. If they're in enterprise units, like 80% subsidized stuff, they pay half the premium you would pay for that, and less than that for the first 5 years. On the PLC program, this is for your barley growers, increased from $495 to $545. So you're going to get some disaster money, I think, possibly out of PLC on barley for this year, and then almost certainly for next, that'll get paid in October for this last crop year. Then the big one, our wheat PLC price increased from $556 to $635. This is all off of what you have for base acres at the FSA. You might be seeding all barley on your farm now, but these FSA programs pay off of what you have for base, right? So this can be a big deal as we roll forward into this. And if any of you guys have acres that don't have base, any farms that don't have base acres, or you don't have enough base acres to cover what you're seeding now, they're going to give us a chance to increase that, and that should happen this summer. So that's a positive too. And then, like I said, the crop insurance subsidies increased on ECO and SCO. Just quick stuff. This year, you're automatically going to get the better of the ARC or the PLC program for those payments when we get those. We'll get those payments this fall for the last year's crop that had the crappy prices, and that'll be all through the FSA. They removed the SCO and ARC rule, so now you can be in the SCO, the county program, and then be an ARC at the FSA, so that was a real positive thing. 100% bonus depreciation and some other tax stuff that they passed in that bill that was positive. But just really quickly, if you had a beginning farmer come back, so here is a 30 bushel recrop winter wheat. Quote here, obviously this premium's cheaper than irrigated because the guarantee's a lot lower, but for this grower, a traditional grower would pay $728 an acre to be in those 2 county programs and in the underlying insurance. A beginning farmer for the first 2 years and only pay $1.82, or a quarter of the premium. So substantial discounts for these young people now, which is a good thing. And then the next, for the whole 10 years, they'd pay half of what a traditional farmer would pay now in crop insurance with this new thing. So enterprise units, I talked to you about that, and I just wanted to harp on this a little bit. Some agents never changed people. What this enterprise units by type thing came out in 22, and especially if you're just a dryland guy or you're just an irrigated guy, if you put ET on there instead of EU on your insurance stuff, that's going to split the winter wheat, the spring wheat, and the durum. If you look at your stuff you get from your crop insurance agent and this still says EU on there, that's combining these together, and it's combining the pulse crops together types before they're going to pay your claim out. So that's a really positive thing they changed in 22. That allows us to have the same discount. But the hard thing with that, it's not available in barley yet. So we'd still throw feed barley and malt barley together if you're doing both types on your farm. So for some reason, they haven't had that in barley yet, which I would think would be coming. And same premium discount as doing enterprise units before, but now you have to have 20 or more acres in 2 different sections of each type. So we'd have to do 20 or more acres of winter wheat in 2 different sections to get that discount, 20 or more acres of spring wheat in 2 sections, etc. So does anybody have questions on that stuff? Like I said, make sure when you look at your policy, it says ET or not EU on wheat or peas. It might say EI on your stuff, and that would separate your guys' enterprise units by irrigated practice. If that's the case, you might want to be in that, but that'd be a discussion with your agent. But if you're strictly dryland or strictly irrigated guy, you'd want it to say ET on there for sure. So this just shows you premium comparison. This is a this year quote on that 30 bushel wheat yield, 948 if you're an optional units and 345 to do that enterprise unit thing. So if you're doing only a couple sections of a crop, it makes way more sense to go into enterprise units and get that discount because your risk is pretty low, right? They also added enterprise units to a bunch of the specialty crops, which is a thing you'd change in March here too. So if you're going to do flax, mustard, oats, or camelina, any of that stuff, this is your chance by March 15th to change those things. And then a big thing this year with this open winter is going to be what happens if my winter wheat fails, right? And if you took the winter option last fall on that, so you pay 10% more for that. But what that winter option does is it allows us to destroy your winter wheat crop and take all the money out of it. If you didn't elect the winter option, you're stuck with just the replant payment, basically. So, oh, sorry, I'll mute that. But so anyways, I just wanted to go through, there's going to be multiple scenarios if you guys have winter wheat fail. If it's just in spots, this replant payment's the most common thing. If you replant winter wheat, it just carries on. Even though you reseeded spring wheat in those spots, the whole thing carries on as though it's all still winter wheat, basically. But that winter option thing, if you have that, if you want to zero your winter wheat out, take all the money out of it and reseed it to another crop, it could be barley or spring wheat or whatever, you can do that, basically. So that's how that works. Whoops, let me get the click in here again. Here's your spring crop prices. Basically, winter wheat's about what it was last year, 575. Spring wheat 612, Durham 690. So Durham finally picked up a little better premium, but the markets are so depressed that it's not a lot. Canola's 22 cents, just about like it was last year. And then your barley without a contract would be 416 down here. And then my best guesses on the pulse crops, and you'll want to watch this if you're quoting with agents. Oftentimes the quoters are plugging in like last year's prices on these pulses, but we're not going to get those for the base prices, I'm sure. This doesn't get released till the first week of March, but this is our best guess calling around to buyers here. So lentils probably went down to 18 cents, what you're going to have for a base, 17 cents on small kabulis, and probably 22 cents on the large, and maybe 10 cents on the smooth peas. So if you're doing budgeting, unfortunately, we probably, to be realistic, need to use these numbers and not what some of these quoters are plugging in oftentimes. And then compared to last year, if you were an ECO, SCO, and the 2 county programs and your individual insurance and enterprise units, it would have been $13 an acre. For identical coverage this year, it's only $766. So if you guys were in all those programs for your budget this year, you should be at about 60% of what you were the previous year because of the additional subsidies that the government added to these things. So there's another real positive thing for our budget stuff. These are the county payouts for 10 years in ECO and SCO, and this is dry land, summer, fall, and winter wheat. So we're talking maybe 40 bushel yields for the trigger on these programs. Toole County, the growers paid in $42 an acre and got almost $400 back. And then even counties like Cascade County, where it had some pretty wet years, and we assumed this program wasn't going to function, the price drops triggered quite a few payments in those counties as well. So $48 in premium and almost $300 in payout. So I just wanted to show you this to get your mind kind of triggering on maybe I better get in these county programs because they've paid a lot over time. One of the things that's affecting these is our county average, and Toole County is getting drugged down because we've been now in 7 years of drought. Same thing in Liberty. That makes these programs harder to trigger, of course, for us. But for you guys that have had good yields, and that might be Yellowstone County, Pend Oreille County, you've actually been building or maintaining your county yields, which makes these programs very, very likely to pay going forward with price moves. So I'm going to skip some of these because I'm probably taking more time than I should here. But one really important thing to remember is some of these SCO and ECO, the county programs, some of them have to pool multiple counties together for yields. So like for Broadwater, you can see here they pool 6 counties together to establish an average yield and then what your harvest yield is for that to trigger it. Mustard and Toole counties, 3 different counties. If you guys do flax in those programs, it's the whole state. This doesn't mean you're not going to get more money back than you pay in these programs, but it might be that your county had a drought, but the state as a whole didn't, and you might not get paid that one year. And same thing, canola in some of these counties throws a bunch of counties together. Where wheat and barley, there's enough acres that mostly each county has its own yields that are established in that. So what are your odds of getting your money back out of these? That ECO program, that one pays when you get to 95% average for the county. That statistically should pay every other year if you're in revenue protection. It's only $258 in premium for $20 in coverage for this quote. That'd be the same if you're an irrigated guy. Your guarantee might be $60 here, but your premium might be $6. It's going to be the same ratio. But it only needs to pay out 1 out of every 8 years, and it only has to pay out every other year to break even in this. So what I'm trying to show you here is just these things are gifts from the government that they want you to participate in so they don't have to do so many ad hoc county disaster things. SCO 1 out of every 12 years. So, and that one in Toole County is paid out 7 out of 8 here, I think, the last 8 years. And then your revenue protection, your underlying insurance, if you're in enterprise units, only has to pay out completely. You only have to get wiped out 1 out of 28 years to get all your money back out of that program. So, and then if you're in revenue protection and you got wiped out, this isn't even figuring run-ups in price at harvest, right? Your guarantee could actually increase above what I'm figuring here for these ratios. So anyways, these are very, very worthwhile programs to be in anymore. They've paid out a lot. And then the last few slides I'm going to cover is what you have coming here still for payments from the government. Most of you probably know if you're on social media stuff or something, the bridge payment thing opened up. If you create a farmers.gov account, which I would highly encourage you to do, if you guys haven't done that already, you can go in there and get all your information from the FSA, like your base acres. You can look at your FSA maps and 578 information, but the big thing is it kind of fast tracks you on some of these disaster programs. So that bridge payment's going to be huge for all you guys. It opened up on Monday. We went in and did ours for our farm here, and it was like a 30-second process over the internet. So if you don't want to go to the FSA office, you can go in there, you can apply for that. One quirk we found in that is we had some winter wheat that had failed that we seeded back to spring wheat. They actually paid us twice on those same acres on the wheat because they considered that 2 crops there. So if you were a guy lucky enough to have failed winter wheat, you actually get double paid on those acres when you reseed it to spring wheat, or we got $80 an acre out of those. So, and that's actually written in the rules of that program. That's just a kind of a quirky thing with it. So, big PLC payments coming in the fall. I can quickly review how that will pay for you guys because this is something you can use on your budget for the bank, the projection going forward if you want. This is money coming in October for last year's crappy prices. So wheat and barley, we're going to look at just really quickly on the screen. This program averages all the national average prices for these commodities from June 1st all the way through May 31st. So we're still in the average of this. Your trigger price on barley is $5.45. The trigger price on wheat is $6.35. So barley's showing just a little payment right now. It's showing a 5 cent a bushel payment, but that's something. The wheat though is huge. So $1.45 a bushel payment on what you have for base acres for wheat in this program. And then the pulse crops too, they upped the base prices on all of those, and they're all projecting some pretty sizable payments per pound too. If you have pulse base acres, which a lot of people don't, because the last time we established your base acres, there wasn't a lot of pulses being seeded then, right? So yeah, I'm going to click through these real quick, and then we just go on to questions. Just real quick example of how that PLC pays, so you guys can figure it on your own if you want. But we have $6.35 base price for wheat. The market year average price we're going to say right now is $5 a bushel. Remember, I think it was $4.90 on that other slide, so we're really close to what I have in my example here. Sorry, there's something wrong with my clicker. Okay, so we have $1.35 a bushel payment rate that we're going to get on wheat. This is pretty well established because we're so far into the average that this isn't going to change much whether the market goes up or down now. So on farm 1, 2, 3, 4 at the FSA, you have a 40 bushel established yield for wheat there. That was set up probably 10 years ago, the last time you guys established yields at the FSA. So this doesn't matter if you seeded this whole farm to peas or barley. If you have base acres of wheat, we're going to get paid on this for those base acres of wheat. We're going to get 40 bushels times the $1.35 a bushel, which will be $54 an acre for farm 1, 2, 3, 4 in this example. So you had 1,000 base acres of wheat. This program only pays on 85% of what you have for base acres. It's just that way. This number might change when they rewrite the farm bill to 95. Who knows? But you find out I have 1,000 base acres of wheat on this farm. I'm going to get paid on 850 acres. And I'm going to get on that 850 acres the $54 an acre. And I'm going to get that payment in October on my farm. If for some reason they go back and they figure out ARC for your county and it's higher for this crop year, you're going to get the ARC payment instead of the PLC. Or more likely, because more likely PLC is going to be the highest because of where the prices are. If you guys enrolled in ARC, but now PLC is the one that's triggering the payment, you guys for 1 year are going to get that payment instead. And that was just a kind of a gift because they changed course in the middle of the year for you guys. So that could be a big line item on your budget. If you guys are doing banking, make sure those PLC payments get plugged in there because 1,000-acre farm or a couple thousand acre, I mean, that could be a fair amount of money. There are payment caps on this, which I'll go through at the end too. But should I elect ARC or PLC? For 26, they're going to have to do all that base acre refiguring before they're going to make you elect this. So we're going to be so far into the crop year that we might elect this in August and have a really good idea. Hey, the markets came back and I don't think PLC is going to trigger and my county was in a drought, so I want to be in ARC for this year. Or hey, the markets are depressed, but my county had a pretty good yield. I'd want to be in PLC. And for 1 more year, we're going to have enough data to pick this without guessing, I think. And then after that, they're going to go back to making you pick this in March, I believe. But so that's that. And then SDRP stage 2. A lot of you guys might have got paid in stage 1 if you had claims in 13 or 14. You have to have a qualifying disaster happen in your county to trigger this. For a lot of people, that could be excessive heat, which is what happened in 24, I think, or 23. One of those 2 years. But what this stage 2 is for you guys that didn't quite have a crop insurance loss in 23 or 24, but you were close. To go in to see if you qualify for this, you have to request your app from the FSA. These aren't pre-filled and sent out to you. So I would go into your FSA office if you were in that scenario where, gosh, I was right on the edge of getting paid on the crop insurance, but I didn't quite get paid. I would go in and request this. And the other thing with this is we can use quality issues to drop your production for this too. So you might have been at your average yield or better, had barley that was rejected and had to sell it for a reduced price, and that could kick you into getting paid in this if you didn't get paid in stage 1. So lots of factors to figure there, but if you were one of those guys that was right on the edge, that's where this really would fit well. And there's no harm in asking the FSA to generate your apps. You can generate those and then look through them, and if it doesn't look like anything's going to pay, so be it. If you want to apply quality stuff to it, you're going to have to prove that happened. So you'll have to get them settlement sheets that show that, hey, I sold this for feed barley for $3, or I should have got $6 here. But for a lot of you irrigated guys that maybe weren't quite in a claim, this might be one that could pay a fair amount. Anyways, so does anybody have questions on that program? It's not very well covered by the FSA, so I just wanted to kind of show you that's available. And that's going to close out in April. So if you think you might qualify, I would get in there relatively soon before you get busy. The one peril, that doesn't qualify in that too is hail. So excessive heat, drought, weird stuff like excessive cold or cold snap or something, that all qualifies, but not hail. So it could be hail combined with hot weather though. So if your yield was already depressed and then you had hail, and that's what was a combination thing, they said that would probably fly too. But okay, they've already dispersed $6 billion out of that program in stage 1. Assuming the second stage only pays half that, let's say for guys that fall in that little bubble there, that would leave about another $5 to $6 billion left to top this program off. So if you got paid in stage 1, or you get your stage 2 payment, they only paid 35% of it up front. I think you're going to get a decent sized top-up payment on that, probably in May as well. So Payment limits on that PLC stuff, that's going to be big for you guys because it's going to trigger some sizable payments on the bigger farms. That changed from 125,000 to 155,000 per entity. There's some stuff in that big, beautiful bill that might change so that S corps or LLCs possibly could be treated more like partnerships where you might get multiple payment limits. So that could change for the better. And then that SDRP program, it depends on if less than 75% of your adjusted gross income comes from farming. Then you'd only have $125,000 payment limit, and that's per crop year, though. If all your income or most of it comes from your farm, then you have a $250,000 limit per crop year in the SDRP program. So pretty sizable limits on that. And there's some crop insurance linkage stuff. So what do we always suggest to our agency? 75% revenue protection, still the best value in enterprise units, maybe 70% in optional because the premium jumps a bit in optional between those two. I would take ECO and SCO and everything you can. Even in irrigated, it's paid back, like you guys saw, probably 5 times what's been paid in it in the past. And then PLC at the FSA till the prices rebound. And then if you're a cattle guy, there's a program called LRP where you can buy a subsidized put through the crop insurance side of things. I would seriously consider that too if you're in cattle business. So and never, ever, ever take YP in a crop unless there's a good reason. Contract pricing for waxy barley would be one if anybody gets back into doing that. Or if you're an organic guy that's doing feed barley, those would be 2 situations where the only way to use your contract would be to be in yield protection. But yeah, so that's kind of the end of what I had. So now we've kind of just transitioned into the question part, I guess. If that sounds good. So does anybody have horror stories on how the malt endorsement didn't work right or something? Because I'd be happy to kind of go through what went wrong there if you want.
Corey, what does SDRP stand for?
Oh, yeah, sorry, I have all these acronyms.
Mhm.
But that's Supplemental Disaster Relief Program. So that was an ad hoc disaster thing the government came out with just to inject more money kind of into the farm economy. And if you would have been paid in stage 1 if you had a crop insurance loss right up front. So the stage 1 guys just automatically got paid once they signed their app. The stage 2 guys have to go in and do the extra work to get paid on this program. So, but that's an FSA program that's supplemental disaster relief, basically. Yeah. I'm certainly open to whatever questions you guys have on that program. I know it's really confusing, but I was hoping if we went through it with example of what it can do to affect claims long term, it can be pretty substantial to be in one versus the other. The other thing, one other question I get on this, which I didn't cover very well in this, if I'm in optional units, and I'm an irrigated guy, let's say, and I do the malt endorsement, will they settle it right down to the unit level? And they will. But we'd have to be able to track that production that got rejected back to what unit it came from somehow for you guys. So, but I'd be happy to go through that individually if you have questions. That QR code that's on the screen, if anybody wants to, you can scan that and you can contact me that way, or I'm sure you can find our website. And I'm certainly more than willing to help just decimate this information out as far as how the program works, because there's just so much misinformation on how some of that gets figured, or hear a lot of stuff about, oh, the malt endorsement just doesn't work. I think you can see in that example, even if you're irrigated, there's pretty good reasons to be on the revenue protection side in that instead. But yeah, any more questions?
Corey, there's obviously a lot of information here. I know you recorded it. How does that work? You send me a link and then I can share that with growers that maybe want to watch it again or miss the presentation entirely.
You bet. I will save this at the end and then I'll upload it to YouTube. So it'll just be a YouTube link thing. And then I'll email it to you and you can share it with everybody. And you're certainly, welcome to review it and ask me questions if you want or whatever. So. Yeah, anything else? I certainly very much appreciate you putting this together because it seems like it's very misunderstood sometimes, and it's good for you guys to know on the cooler side, on the merchandiser side too, how this works, I think. So, Yeah.
Absolutely. Thank you so much, Corey, for taking time out of your day to do this. I think it's very useful.
You bet. Well, thanks. Thanks you guys for joining me. And like I said, I'll put this into a YouTube link that'll take about an hour. I'll email it to you, and then you certainly can review. I know I talked pretty fast and there was a lot to go through there. So if you have any questions, always feel free to contact me for sure. So yeah,
Thank you.
Yeah, thank you guys. And one quick pitch for the agents, if there's still people on your, if your agent didn't go through this very well with you, that is not on the agents usually. It's that this is not covered in training at all on the crop insurance side of things. And so there's some misunderstanding. Your agent misrepresented this, and that oftentimes is that we just don't get trained on these specialty programs very well either. So I'm just a dork and I like to read all these rules and then put it together. But I wouldn't harp too hard on your agent if this wasn't explained.